particularly the NASDAQ, was looking for a reason to bounce.
Yeah, any reason. And I mean, you're getting the bounce. Obviously, you are, Rob. Tech's getting a little bit of a bounce. I mean, NVIDIA's been up reasonably sharply today. It's up 6%. Tesla's up. A bunch of the Momo names, Palantir, AppLovin, among others, are up. We're still substantially off of our record highs, though, for many of the mega cap names. Tesla included in that, down 49%. NVIDIA down 25% from its record high. Amazon is as well. You have made a move, though. If I ask you the question, has tech corrected enough? Is it time to buy tech? You make a move today that suggests you think maybe it is.
Yesterday, actually.
But
we did at the end of the year. We talked about it a lot on this show. We thought their tech was very extended. Actually, a lot of the high momentum names were very extended. And we reduced things like Vistra Energy. You saw us trimming those things, trimming Broadcom at year end. And what we did is we bought the value index. We also bought a bunch of value names. We bought the value index at that time at the expense of our technology overweight, which we had all the way through December. Value has outperformed tech by 12.5% since that time. Yesterday, we trimmed that value overweight. We cut it in half. There's still some great trends in financials, so we didn't want to totally take that out, but we did take out half of it, and we started buying tech. And in fact, in the last couple days, kind of like Steve's been doing, I think, I've heard him on the show a little bit, for clients that had a lot of cash, we've been selectively putting our toe in the water. Names that we're adding are names like NVIDIA. We've been adding NVIDIA on this re-rating because it's become meaningfully more attractive from a price standpoint. We've also added Amazon, which trades at a pretty big discount to what it's been trading at historically, despite the fact that it's expensive relative to the consumer sector. And so I think when you have moves like this, when you break below the 200-day moving average, and since the global financial crisis, every time you've broken below that 200-day moving average, 14 of 15 times, you've seen positive returns 1 year later. So it doesn't mean that we've seen the lows, but you better be in an athletic stance and ready to take advantage of this. And anybody that's just paralyzed by this has got the wrong viewpoint. I'm not selling into the strength. I'm looking to buy as things weaken, possibly more from here, but definitely own things that we've wanted to own.
Well, because this is a game not about trying to time things perfectly. It's just trying to take advantage of dislocations in some respects that you see that will be advantageous and viewed as such over the long term. Kind of like Altimeter's Brad Gerstner, who, just like Rob Sechin, has been buying NVIDIA, he said today on this network during this pullback. Let's listen.
Periods of uncertainty. We have high economic uncertainty, high political uncertainty, and high technological uncertainty.
And high multiples.
Right, at all-time high multiples. So there's only one thing that can happen. Discount rates have to go up, right? Risk premiums have to go up, and when they do, multiples come down. So for us, that was just a period to say, okay, we'll go to the sidelines, we'll wait this out a little bit. We've seen the markets come back in, and I have to tell you, we were buying some yesterday, because now you see NVIDIA at 18 or 19 times next year's earnings. Now you're getting paid.
All right, so that's Gerstner talking about NVIDIA. Weiss, you bought more Meta. As I said, Meta's down 17% from its record high. Don't know if the bottom in Meta is in or not. It is up almost 3% today. Why now? Even for somebody who's grown more cautious, who has more cash than they've had for the recent period of time we're talking about, why deploy some of it at Meta now?
Well, look, Meta, and I said this when the stock was trading at the highs, was overvalued. And I knew it would correct, because it just couldn't maintain that valuation. That was euphoria on Trump's win, which was obviously misplaced. So I was willing to suffer for it coming down, and I had trimmed. I had a supersized position, and I had trimmed a little bit. Now at this point, when you're selling at a slight discount to the market, despite having, I would say, not complete protection against the craziness and the chaos in D.C., but pretty good protection, except for the supply chain for the data centers, which they're largely having others build, and which is a small number relative to the overall revenue. So I think that's the time to step up when the multiple comes down. No, look, could it go lower? Absolutely could it go lower. You know, it could go lower, but to your point, you can't market time. It's impossible. So when I bought the stock, when I added to it yesterday, it was my final trade yesterday, and I added to a couple others. I don't know if you want to talk about them.
Well, you bought more Taiwan Semi and Netflix.
Right. So, and the reason is those are companies where I'm very confident in the fundamentals, and I believe whether I'm wrong on the trade, because they're all good-sized positions already, that I'm willing to stick with them, versus going into the stocks that I sold a lot of, which are truly just trades. You don't want to get married to trades and find a different reason to own them. These I own because of the fundamentals. So it'll give me an opportunity to participate in the bounce of the market that I thought would be coming. I do not think it's sustainable, but you know, I've got a lot of cash.
That Meta comment that he made, because you asked me something on the February 27th show. Meta was up 20% for the year. We haven't changed our positioning, not at all. We've owned it since December of 22. It's our largest overweight in the portfolio. You said, would you buy more? I said, no. This stock's way ahead, to Steve's point. We can be patient and still own it. It's re-rated by 20%. Today, if you were to ask me that question, I think you can, in fact, be a buyer of that name.
And if you take a look at Netflix, also, I'm looking at companies that are insulated. Netflix, you know, people have cut the cord. So what will they do before they cut Netflix? They'll cut the services, streaming services you're not happy with. You can also trade down, go to the ad-supported service. With Taiwan Semi, look, I don't think anybody's crazy enough to stop the supply chain for semiconductor chips. And I don't think there'll be heavy tariffs when they talk about investing. But they've got a queue that are people waiting for capacity. We hear NVIDIA talk about that all the time. So to me, this stock is very undervalued here.
19
That's why I bought more.
times.
Yeah. And I don't see, by the way, I don't see where NVIDIA is trading at 19 times next year.
Yeah.
It's still significant.
It's
like
24.
25.
Yeah, but he was talking about 26.
Yeah, that's what I'm talking about.
You know, these guys aren't the only ones who are doing this kind of movement within the market. Our Stephanie Link is as well, and has been, and she's told you about it every time she's been on the show, and sometimes when she hasn't, like right now. She joins us to talk about some moves, Steph, that you've made. You bought more Amazon, you bought more Palo Alto, and you bought more Target, which has been really beaten up. But give me the mega cap view first through your Amazon purchase.
Sure. So I trimmed Amazon in early February. Stock is down 19% since then. It's now trading at a pretty interesting valuation, in my mind, 13 times EBITDA. Versus historical average of 17.5 times. When I sold Amazon, it was at 17 times EBITDA. So it was rich relative to its history. And we know, Scott, that the story on retail, the bigger getting bigger. Amazon, Walmart, Costco, they have 46% market share. Amazon has 28% market share. And Amazon actually grew their market share 410 basis points in the past quarter. So they're humming there. Profitability at AWS is absolutely on the rise. And I think there's still capacity constraints, so I expect second half of the year to see an acceleration in AWS. So I like that one very much. Palo Alto is a fairly new position, Scott. I only started buying it about a month ago. It's down 14%, though, since I bought it. And you know I'm a big believer in cybersecurity, and these guys are a top 5 player in the cybersecurity sector, and they are building out scale through platformization, which could be a $15 billion annualized recurring revenue opportunity for them. So I think the biggest thing is that it's trading at 14 times price to sales, which is not cheap, but CrowdStrike is trading at 22 times. It's recovered all of its valuation discounts post the glitch that they had. So I sold CrowdStrike and bought the Palo Alto.
Yeah, it's the Target one, frankly, that I'd like to hear more about because there are some serious questions, obviously, about where the psyche of the consumer currently is, not to mention a company that's had some issues of late. Why now? Why this?
100%. This is a turnaround story, but I think you're seeing hints of improvement. The stock is down 24% since February. It's trading at 12 times earnings, and they just gave you earnings guidance for this full year, which I thought were actually better than expected, and it yields 4%. This has never been a traffic problem, Scott. Traffic in the past several quarters have been in the 2% level. They just haven't had the right product mix. They had more discretionary versus consumables. But last quarter, you actually saw an improvement in discretionary, and their same-store sales beat expectations, 1.5%. It's a tough environment across the board in retail, but I think they're doing all the right things. The issue with Target is they're going to now need to string along quarters like they just had for the next couple of quarters to get the confidence back from investors, because it's been very inconsistent. But I do think that while it's a show me story, I do think that they have the right products. Their inventories are under control. They're focused on where they need to be, which is operating margin expansion.
Those are all, additions to positions you already